Hi everyone, and welcome to the channel. Today we're going to talk about a topic that can completely revolutionize how you build wealth with real estate, especially if you're busy and can't spare time being a hands-on landlord. That topic is real estate syndication. Now, if that term unsettles you slightly or sounds rather terribly super Wall Street, don't worry. By the end of this video, you'll know exactly what it is, how it works, and whether it might be a good addition to your portfolio. Think of it as your crash course in entering major league real estate without ever having to twist a single toilet yourself. Let's get started. So what is it exactly? Basically, real estate syndication is literally a legalized partnership. It's when a bunch of investors pool their money in order to buy an absolutely ginormous property, like a huge apartment building or commercial office complex. That would be completely out of anybody's price range to buy on their own. This model is the sweet spot. It bridges the gap between the hands-on experience of being a landlord and the purely hands-off approach of simply buying shares in a public REIT. You own real fractional interest in a specific cash-flowing property. It's kind of like crowdfunding, but for accredited investors and a much more professional, structured manner. There are two most critical positions in every syndication you ought to familiarize yourself with. First, you have the general partner, or the GP. The GP is also known as the sponsor. He's the diligent horse behind the deal. He's the one who buys the property, structures the financing, manages the renovations, handles the day-to-day work, and finally makes the exit strategy. They're doing all the donkey work. And then there are the limited partners, or the LPs. They're the passive investors. They invest the money for ownership shares. They have an opportunity at the cash flow and the tax benefits, but they have absolutely no operational responsibilities. They're along for the ride, hoping the GP does the driving. Let's break it down a little more so it's as precise as possible. The general partner has enormous responsibilities. They source and fund the deals. They structure the financing, and this one adds up big time. Sometimes they are individually obligated to sign guarantees on that debt. They handle the daily operations, execute the business plan, and they're the ones sending out the investor reports. Now, for the limited partner, your obligation is so much more front and back passive. Your main job is to do your due diligence on the sponsor before you put in the money. You put in your money, you review the performance reports that are sent to you, and you attend to your tax information on an annual basis, which comes in the form of a K-1. Your first responsibility is to be a smart investor initially, and then a do-nothing as the deal unfolds. This leads us to a critical difference in risk. The general partner is assuming a much higher level of personal risk. Since they're standing behind that obligation personally, if the investment turns out to be a disaster, their own personal resources could be jeopardized. You, as a limited partner, enjoy so-called limited liability protection. Your financial risk is usually capped at the initial amount of money you invested. You can't lose more than you invested, with one potential exception that we'll consider shortly. And this brings us to the one thing most important to keep in mind throughout all of this video. Because you, as LP, are passive and protected, the general partner's competence, experience, and integrity become the biggest determinants of whether your investment succeeds or fails. Your job is to choose a good driver, not backseat drive. So how exactly is this whole business legally built? The majority of the time, syndications appear in the form of an LLC, a limited liability company, or an LP, a limited partnership. The most popular choice is the LLC because it's very flexible, and it has so-called pass-through taxation, meaning that the entity itself does not pay taxes, and there is no double taxation. The LP form is also good for separating the active GPs from passive LPs very clearly. The rulebook for operating it all is a document called the Operating Agreement. This is serious business. This outlines everybody's duties, the dividing up of the profits, the voting rights, the whole 9 yards. You need to read and understand this before you invest. So how is that different from other ways of investing? Let's have a brief comparison. With a REIT, you're buying a share that's publicly traded. It's very liquid. You get immediate diversification, but little control and generally lower upside. With old-fashioned private equity, you're usually putting money into projects or companies with virtually no collateral, which is very risky and possibly never receive cash flow. Real estate syndication falls somewhere in between. You directly own a chunk of real property, but it's not liquid. You're typically in for 3 to 7 years. It's accredited investor only, but it has much more potential return because you're actively building on a tangible asset and enhancing value to it. It's a strange combination of control, upside, and passivity. Now, this is very important from a legal standpoint. Real estate syndications are securities under federal law as well. That is, they fall under the jurisdiction of the SEC, just like stocks and bonds do. In order to avoid the huge cost and paperwork of an offering to the public, sponsors almost always use what is called a Regulation D exemption to raise funds on a private basis. Sponsors are also required to conform to state-level law, better known as blue sky laws. So it's not the Wild West. There's a proper regulating environment protecting all parties involved. There are two main avenues under Reg D that a sponsor can take, Rule 506B and Rule 506C. With 506B, the sponsor is not allowed to publicly solicit the transaction. They can only rely on pre-existing relationships with the investors. They can take in an unlimited amount of accredited investors and up to 35 non-accredited ones. And they can verify your accredited status through a simple self-certification questionnaire. With 506C, the sponsor can market publicly. You can see such deals online or on social media. But the flip side is that all the investors need to be accredited, and the sponsor has to perform strict verification, e.g., authenticate your bank statements or tax returns. The sponsor choice is reach versus administrative headaches. 506C lets them cast a wide net, but they have to do a lot more paperwork. So who is an accredited investor? There are 3 main methods of qualification. First, the income test. You need to have earned over $200,000 on your own or $300,000 with a spouse over the last 2 years and expect to earn the same this year. Second, the net worth test. You need to have a net worth of over $1 million on your own or with a spouse. And here's the catch. You need not include the value of your primary residence in that calculation. And third, the professional test. You can pass based solely on having some financial licenses. For example, a Series 7 or 65, regardless of income or net worth. A syndication investment has a defined life cycle, usually 3 to 7 years. It starts with Phase 1, origination, where the sponsor finds the deal, underwires it, and raises the money. And then there is Phase 2, acquisition, due diligence, inspections, audits, legal work, and then closing on the property. Next is the longest phase, Phase 3, operation. This is when the sponsor executes the business plan, operates the property, does the renovations, and makes you quarterly cash flow distributions. And it all culminates in Phase 4, exit, when the property is sold or refinanced, the profits are shared, and the legal vehicle is dissolved. Now let's talk about how the sponsors are paid, because you want to know where your money's going. They usually get paid through fees and a performance bonus. They usually charge an acquisition fee for finding the deal, an asset management fee for ongoing oversight, and sometimes a construction management fee for overseeing refurbishments. They can make money on selling the property when they do, but the most important part of their compensation is the promoted interest, or the carry. This is a performance-based share of returns that they only get after you, the LP, have realized your hoped-for return. Here's a pro tip. If the base fees are excessive, it can be an indicator that the GP benefits no matter how badly the deal does, which is not in your interests. You want their remuneration to be heavily linked to that promote. The waterfall is the financial arrangement that dictates what share of the profits will be split between you and the sponsor. It's called a waterfall because money falls down through tiers, filling one bucket before overflowing into the next. This waterfall form is the ideal alignment of interests device. It ensures that the general partner only gets their fat check after you, the limited partner, are repaid in full and get a fair return. They dine last. Let's examine the typical tiers of that waterfall. First, return of capital. 100% of the cash flow goes to the LPs until you've gotten your money back on your original investment. Safety first. Second, the preferred return. This is a target return annually, perhaps 8%. so that 100% of the cash flow belongs to you until that hurdle is met. Then, typically, there's a catch-up provision. This is where 100% of the next slice of cash flow goes to the GP to quickly catch them up to their contracted level of the profits. Finally, you hit the promoted interest. Now all the residual profits are allocated according to the deal. For example, 80% to the LPs and 20% to the GP. That is how they're being compensated for their outperformance. Okay, let's get into one of the bonuses, the tax advantages. Because syndications are usually formed as pass-through organizations like LLCs, the entity itself doesn't pay taxes. All of the income, losses, and deductibles pass directly through to you on a statement called a Schedule K-1, which you then report on your personal tax returns. The biggest benefit here is depreciation. You can depreciate the building's cost over 27.5 years under the IRS tax rules. It is a paper loss that shelters your actual cash flow from taxation. You have cash flow in your pocket that is positive, and yet, on paper, you have a loss, so you don't pay much or anything at all on that income. It is a phenomenal wealth-building tool. They can supercharge that depreciation with something called a cost segregation study. This separates the property into its components, which then can lead to something called bonus depreciation, where a huge amount of depreciation is claimed in the very first year itself. This can create instant giant tax savings, but caveat emptor. Instant forgiveness is only temporary. When the property is finally sold, that instant depreciation is recaptured and taxed unless you forestall it again using a trick like a 1031 exchange. Discussing 1031 exchanges, this is a complex but valuable tool. It permits you to sell a real estate investment and defer the tax on the profit by reinvesting the proceeds in an identical or similar property. The catch is, your ordinary LP interest in a syndication is defined as a security and therefore is not direct real property and does not qualify under a 1031. To get around this, some syndications will use a special vehicle like a tenancy in common, TIC, or a Delaware Statutory Trust, DST, to give you that direct property interest necessary for a 1031. It's complex, but it's available if tax deferral is a primary concern for you. All right, now we have to talk risks. Syndications aren't risk-free. First, a liquidity risk. Your capital is locked up for years. There is no open marketplace to market your interest in case you need money. Second, leverage and market risk. Leverage magnifies gains and losses. A reversing market or poor financing can wipe out equity. Third, and most importantly, sponsor risk. A bad sponsor can ruin a great property. Their incompetence is your biggest risk. Finally, capital call risk. The sponsor may call for extra funds to save the deal at all costs. If you can't or won't chip in, you may face dilution. So how do you sidestep that number one risk, the sponsor risk? You do crazy due diligence. First, check their track record. Don't look at years of business. Look at miles on the road. How many deals have they done? Check their past projections against what actually occurred. Second, look for specialization. Do they have deep experience with this specific asset class and geographic market? Third, check for financial alignment. Are they risking their own substantial capital in addition to yours? Skin in the game is all that counts. And fourth, evaluate their integrity and transparency. Are they clear communicators? Do they provide thorough reports? If they go radio silent during tough times, that's a huge red flag. All right, let's wrap this up with your key takeaways for success. Number 1, prioritize sponsor due diligence above all else. Spend most of your time vetting the people, not just the property. Number 2, examine the money alignment. Make sure the GP's pay is heavily tilted to that perform-based promotion, so they only get the big bucks when you get the big bucks. Number 3, check the underwriting. Are the assumptions conservative and in reality, or are they just rose-colored assumptions? Be suspicious. And number 4, confirm all the tax and legal arrangements. Understand the Regulation D exemption they're using, and if the transaction is set up to allow your future goals, like a 1031 exchange. Syndication is a great vehicle for passive wealth building, but your success relies on you being an educated, diligent investor right from the start. Thanks for watching, and I'll see you in the next video. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.